Oftentimes people see advertised rates online, or maybe they hear it on the radio, but those advertised rates almost always come with fine print points or origination fees that are being paid, and they also make assumptions about the details of the file. There's actually over 30 different loan level pricing adjustments that can impact the interest rates. If we weren't competitive on rate, we wouldn't close as many loans as we do. Almost everybody we speak with chooses to finance with us unless, they feel some obligation to a friend or family member who might be a loan officer. Rates are almost everyone's first concern and what most questions I get revolve around. So to explain how that part of the industry works, everything's really determined by the secondary market, saleability, and risk. Loans are originated on the primary market through lenders like myself to consumers like you, and then sold in the secondary market or transferred to a servicing department, which may feel like it's being sold. There are banks, like B of A, Wells Fargo, and credit unions, and they all raise money through their deposits and then can lend that money back out through interest-earning products, things like mortgages, auto loans, credit cards, and all those types of products. There are times that since it's their own money, they can sometimes lend at lower rates, but they also typically have very stringent guidelines that most people don't qualify for, or those rates are only limited offered for a limited time. Then there are mortgage banks who go to large investors like UBS and obtain warehouse lines, which are basically just sums of money that can then be used to fund loans like yours. Just like a credit card, there's a limit to the funds that a direct lender has access to, and there's interest that these banks pay on the money that they borrow to fund your loan. So to free up that money so that they can continue to lend to people needing mortgages, the funded loans are then sold on the secondary market. And then there on the secondary market, buyers of these mortgages are typically government agencies like Fannie Mae, Freddie Mac, PennyMac, or another institution like even Chase, Wells Fargo, or Wall Street. But if there's nobody willing to buy a loan on the secondary market, then the lender has to keep the loan, which will keep them from making future loans and lending to another home buyer. So if that's the case, they're likely going to need to service the loan themselves until they can show timely payments for whether 12 to 18 months on it. And then at that point, the market will probably see the loan as less risky and purchase it. Now, because of this, insured loans have the requirements they do because it increases the likelihood of timely payments, and those type of loans have insured buyers, so lenders like to use those products. Most banks have large overhead and shareholders that have to be accounted for when the institutions are deciding what rates to offer. Going back a step, if your loan is in fact sold, and it most likely will be at some point, institutions then package up loans together and create an instrument called mortgage-backed securities. Those mortgage-backed securities can be invested in. The sale of those mortgages is known as securitization, and that basically frees up capital to lend to future borrowers like we spoke about earlier. Now, the ability to sell mortgage-backed securities is simply a matter of supply and demand. If demand's high, that leads to the increase in the cost of mortgage-backed securities and yield on interest rates fall. Now, on the other hand, if there's low demand, that leads to the cost of mortgage-backed securities falling and the interest rates and yields go up. If a loan has a high likelihood of being refinanced or otherwise paid off in the short term, that's bad for investors. So it impacts their strategy, and a lot of these investors are pensions, life insurance companies, other countries, hedge funds, for example. This is the reason that the secondary market's willing to pay less, but because of this, the original lender on the primary market has to increase the cost of rates in order to turn a profit. Now, pretty much every company borrows money from the same places and then lends the money out in the form of mortgages and then sells those mortgages to the same places. So there's really not much room for companies to offer much lower rates unless, of course, that company is willing to take a loss, or maybe they've got less expenses to cover. Rates can vary from bank to bank, but it's typically 1/8 to 1/4%. Really not much different than paying 10 to 50 cents more per gallon when you're choosing which gas station to go to. The real difference is who you work with when you're buying a house matters. I'm not trying to brag, but it is important that you know what our reputation means in terms of giving you a pre-approval that's strong, underwritten to help you get your offer accepted. Not to mention the fact that we're going to protect your earnest money deposit, getting your loan closed on time, and providing exceptional customer service. And yeah, we're really going to go above and beyond just to make sure all your questions are answered and you've got all the information you need to make an educated decision before, during, and after you make the biggest purchase of most people's lives. If you've got any questions, feel free to reach out. Have a great day.